Imagine owning a piece of a global giant, a company like Apple, Coca-Cola, or Microsoft, and having them pay you just for being a shareholder. This isn't about timing the market or selling at the peak. It's about a steady, predictable stream of income. Welcome to the world of dividend investing. At its most basic level, a dividend is a distribution of a portion of a company's earnings to its shareholders. It's your cut of the corporate profit. Every time you buy a share, you become a part owner. When the company succeeds, they share that success with you in the form of cash. But why do companies give away their hard-earned cash? Mature companies often generate more money than they need to reinvest in their own growth. By paying dividends, they reward long-term investors, maintain loyalty, and signal to the market that their business is financially healthy and stable. The concept isn't new. In fact, the Dutch East India Company was the first recorded company to pay regular dividends back in the early 1600s. Since then, dividends have been the bedrock of traditional investing, providing a cushion during market downturns and fuel for long-term growth. Take Apple as a modern example. Despite being a tech innovator, they pay out billions in dividends every single year to their millions of shareholders. This balance of innovation and income makes them a staple for both aggressive growth seekers and conservative income investors alike. Then there's Coca-Cola, a legendary dividend king. They haven't just paid a dividend, they've increased it every year for over 60 consecutive years. This incredible consistency is a hallmark of a resilient business model and a brand that has stood the test of time across global economies. To be a successful dividend investor, you must understand the timeline. It starts with the declaration date, when the board announces the payout. On this day, the company specifies the amount per share, the record date, and the final payment date for all eligible shareholders. The most critical date is the ex-dividend date. If you buy the stock on or after this date, you won't receive the upcoming dividend payment. The previous owner gets the check instead. Timing your purchase is essential if you want to capture that immediate income stream. Next is the record date, where the company identifies its official owners. Finally, the payment date arrives, the day the cash hits your account. For many investors, this is the most exciting day of the quarter, as they see their passive income manifest as real, spendable cash. Most dividends are cash dividends. This is a straightforward payment of a specific dollar amount for every share you own in your portfolio. It's simple, transparent, and provides immediate liquidity that you can use to pay bills or reinvest into other opportunities. Sometimes companies issue stock dividends instead. You don't receive cash, instead, the company gives you additional shares of the stock itself. While the total value of your investment might stay the same initially, you now own a larger piece of the company's future potential. Occasionally, you might see a special dividend. This is a one-time extra payment following an exceptionally profitable year or a major asset sale. These are rare and non-recurring, but they provide a significant boost to your annual returns when they do happen. To compare different stocks, we look at the dividend yield. This is the annual dividend divided by the current stock price. It's essentially the interest rate you're earning on your investment, allowing you to compare a tech stock to a utility company side by side. But beware of the yield trap. A very high yield can be a red flag. If a stock price crashes, the yield looks artificially high. This often signals that the company is in financial trouble and might be forced to cut or suspend its dividend entirely in the near future. This is why we check the payout ratio, the percentage of earnings paid as dividends. A healthy ratio is typically between 30 and 60%. If the ratio is over 100%, the company is paying out more than it earns, which is a clear warning sign of an unsustainable dividend. Beyond the current yield, look for the dividend growth rate. You want companies that increase their payout year after year to beat inflation. As prices for goods and services rise, your dividend income should ideally rise with them, protecting your purchasing power over the long haul. Investors often target dividend aristocrats, elite companies in the S&P 500 that have increased dividends for at least 25 consecutive years. These companies are the gold standard of financial stability, having weathered recessions, wars, and market crashes while still rewarding their owners. Not all dividends are taxed equally. In many countries, qualified dividends are taxed at a lower rate than your regular income. This tax advantage can significantly boost your after-tax returns, making dividend investing one of the most efficient ways to build wealth. On the other hand, ordinary or non-qualified dividends are taxed at your standard income tax rate, which is typically higher. These often come from REITs or stocks you've held for a very short period. Understanding these rules is key to maximizing your take-home pay. To maximize your growth, consider a DRIP, a dividend reinvestment plan. Instead of taking the cash, it's used to buy more shares. This creates a powerful compounding effect. Those new shares then pay their own dividends, which buy even more shares, and so on. A common myth is that dividends are free money. In reality, when a dividend is paid, the stock price usually drops by the same amount. It's a transfer of value from the company's bank account to yours. The total value of your investment remains the same at the moment of payout. Another myth is that dividends are guaranteed. They aren't. In times of crisis, even the strongest companies can cut or suspend payments. This is why diversification is so important. By owning many dividend-paying stocks across different sectors, you protect your overall income stream. Certain sectors are famous for dividends. Utilities, for instance, have steady demand and predictable cash flows, regardless of the economy. Because people always need electricity and water, these companies can afford to pay out a large portion of their earnings to their owners. Consumer staples, companies selling food, beverages, and household goods, are also strong dividend payers due to their consistent sales. Even in a recession, people still buy toothpaste and laundry detergent, making these stocks a reliable source of income in any market. Energy companies and real estate investment trusts, or REITs, are also popular choices for those seeking high current yields. REITs are unique because they are legally required to pay out at least 90% of their taxable income to their shareholders. The true appeal of dividends is psychological. Seeing cash arrive every quarter provides the discipline to stay invested through the volatility. It's true passive income. It's money working for you rather than you working for money, which is the ultimate goal of every investor. You might also hear about stock buybacks. This is when a company uses its cash to buy its own shares back from the open market. This reduces the total share count, making each remaining share more valuable. It's another way companies return value to their owners. While most dividends are paid quarterly, some companies pay monthly. This is great for those who use dividends to cover their monthly expenses. You can even create a dividend carpet by owning different stocks that pay in different months, ensuring you get a check every single month. If you don't want to pick individual stocks, you can use dividend ETFs. These funds own hundreds of dividend-paying companies for you. It's an easy, low-cost way to get broad exposure to the best dividend payers in the world with just a single investment. The biggest mistake beginners make is chasing the highest yield possible. A yield of 15 or 20% is almost always a sign of high risk. Always prioritize the quality and sustainability of the business over the size of the check. A safe 3% yield is better than a risky 10%. In an inflationary environment, companies that can raise their prices and their dividends are one of the best hedges for your portfolio. They help maintain your lifestyle by providing more income exactly when the cost of living is going up. It's a built-in protection mechanism. Consider Johnson & Johnson. With decades of increases and an AOA credit rating, they are the ultimate sleep-at-night dividend stock. Their diverse business model and essential products ensure that the cash flow and the dividends keep coming no matter the economic weather. Even Microsoft, once purely a growth play, has become a massive dividend payer as it matured and generated incredible amounts of cash. This transition from growth to value often marks a company's entry into the elite ranks of reliable income providers for long-term holders. Building your portfolio requires patience. Start small, stay consistent, and let the power of dividends work its magic over the years. Don't get discouraged by small checks in the beginning. Those checks are the seeds of your future financial independence. Water them well. Remember, dividend investing isn't set it and forget it. You must monitor your holdings and their payout ratios at least once a quarter. Ensure the business remains competitive and the management stays committed to rewarding shareholders. Vigilance is the price of security. For many, the ultimate goal is retirement. Dividends can replace your salary, allowing you to stop working without selling your shares. This income-only strategy preserves your capital for future generations while providing the freedom to enjoy your golden years to the fullest. Dividends are a global phenomenon. Many international companies offer attractive yields and geographic diversification for your portfolio. Expanding your search beyond your home country can uncover hidden gems and protect you from local economic downturns. Look globally. In summary, dividends are a share of profits. They offer cash flow, compound growth, and a high degree of financial stability for owners. Always research the payout ratio, avoid high-yield traps, and prioritize quality companies with a long history of consistent increases. Now it's your turn. Start by researching your favorite companies. See if they pay a dividend and how that fits into your long-term plan. Knowledge is power, but action is what builds wealth. Take the first step today by identifying one quality dividend payer for your watch list. Investing is a lifelong journey. Dividends can be the fuel that keeps you moving forward, regardless of what the market does next. Thank you for watching this deep dive into dividends. We wish you the very best on your path to financial independence. Happy investing.